Welcome to the first of my educational videos. I will try and keep these videos as short as possible to make it easier for viewers to absorb the content. I will also keep the language as simple as I can and avoid financial jargon as far as possible. The first video is meant to introduce first-time investors to mutual funds and help them understand basic concepts. What are mutual funds? Many investors pool their money and invest in mutual funds. Each fund has a net asset value or NAV that is released daily. The NAV gives you the actual value of the holdings of that mutual fund per unit on a daily basis. When an investor invests, units are given to the investor based on the NAV of that day. When an investor sells, money is given back to the investor based on the NAV for that day. The money invested in the fund is deployed into the financial markets based on the investment objective of the scheme. The investment objective is published and should be reviewed before making the investment. The investor can sell units whenever money is required. We now address the question of risk, and a lot of people feel that mutual funds are very risky, and that is not true. There are schemes that have very low risk and those that have significant risk. The key is choosing the scheme that is right for you. For example, overnight or liquid debt funds take on very little risk, whereas sectoral or thematic funds take on much higher risk. Certain investment strategies may also be riskier than others. Risk and reward are linked, and if one wants a higher return, one must be willing to take on the added risk. To ensure that subjectivity is taken out of the equation, all securities that are a part of the portfolio are valued daily based on exchange closing prices. There is always a possibility that one may see a temporary drop even in the safest of schemes. What securities do mutual funds invest in? Equity funds invest in stocks of companies, whereas debt funds invest in bonds or debentures or government issued securities. Commodity funds would invest in silver, gold, etc., and real estate funds would invest in properties. Hybrid funds invest across asset classes. So a multi-asset fund may invest in all of the asset classes listed. This is a key question, and it's why one needs to invest. So we have savings, which is where people uh, spend the money that they need to and put the rest of it in the bank. And normally that ends up earning about 4% interest annually. So inflation is a term that is used to define the change in purchasing power on an annual basis. In India, inflation has traditionally been in the range of 7%. That means something that costs 100 rupees today will end up costing 107 in 1 year. One must ensure that the money they have grows at a rate greater than or equal to inflation after taxes to ensure purchasing power parity. Keeping money that has been saved after expenses in a bank account will not allow someone to maintain their purchasing power. Saving is important and money should be set aside, but also money also needs to be invested for it to grow. The, there is also questions on whether mutual funds are for everyone or whether they're for specific individuals, and mutual funds are for everyone. They do not have any barriers. They're open to everyone. A suitable scheme can be found for everyone. It is very important to note, though, that these are meant to be long-term investments and not meant for immediate gratification. Each fund has a suitable investment horizon, and money should be invested only if the investor plans to stay the course. I hope this video was helpful, and do feel free to reach out to me at the email address or mobile number that you see on screen. Um, do visit my website, which is www.aditshah.in. That's spelled www.aditshah.in. Links to my social media pages are also available there. Do follow me in case you found this video to be beneficial. Thanks for taking the time to view this video. Your feedback is appreciated.